might have gotten a better deal by financing. Who knows? What if it was free credit and you could use their money for free? You might got any ideas why you might choose to do that rather than pay cash? Okay, what else? Okay, what else? Question, and they are going to be being used. Hey, somebody over there have an answer?
No, I need to hear the question.
Oh, the question was, well, hey, if we bought $1,500 worth of supplies here, and we kept our equation in balance, but we're going to be using up those supplies, how does that work? Anybody know?
You're all the time, you will at any given time have $1,500 worth of supplies.
Well, no, our supply's going to go down. They're going to go down as we use them. Anybody?
Every so often.
Yeah, that's right.
I don't know the correct term, but they just say, okay.
Who's had intro? Has anybody here had intro to accounting? Okay, one of y'all guys that had intro, how do we handle the supply usage?
Supplies expense.
And when do we do that?
The end of the month.
The end of the month. And we're not going to do this until chapter 5, but we do make the adjustments. You're absolutely right. As we use up things that aren't in your during the month, then at the end of the month we go in there and make the adjustment. And what we do is we adjust the supplies account to show the correct amount at the end of the month. Okay, and then we also show it as an expense to come out of our balance. So that's exactly what happened. Good question. So that's good, but we don't worry about that now, everybody. We're just, but that is exactly where it's going. Good thinking. Good thinking. Okay. All right. So now we make a payment on the account. On the account, meaning on the accounts payable. Payable means we got to pay it. Okay. If it says accounts payable, that means we have to pay that account. Okay. So what happened? If we have to pay the account, we've decided to go ahead and send them $2,500.
Credit accounts and debit cash.
Okay, so cash is going to be reduced. And on this side, accounts payable is going to be reduced. Right? And it does change the numbers a little bit, right? Just means we own more of it ourselves than creditor doesn't own that amount of that equipment anymore. Okay. So the amount the creditor owns went down, see? Okay. Okay. All right.
So with your assets, not standard.
No, the asset stays. We still got that $6,000. It didn't change. It didn't change the amount of that value of the equipment at all. The equipment's already been put in there, right? The only thing we did was we went ahead and took it out of cash. Had we bought the equipment with cash to begin with, that would have already happened at the beginning. This is the part we're going to hammer in because chapter 2 and chapter 3 are critical. Once you get it, once you get the understanding of what's actually going on, you won't have any trouble at all from now on in accounting, actually. Okay? This is the part that you need to lock into your mind. What's happening? What's happening right now in this equation? Because the equation is the foundation for all of our accounting from now on forever. All your accounting classes. Okay. Is everybody following it so far? And we're going to do some exercises where you can practice, and we'll do some more. But because I'm going to stop as soon as we get to where we. Okay. All right. We make a payment, so now we know what happens when we make a payment, right? Okay. Well, I'm throwing a lot of things at you, but we're going to dwell on them a little bit. What happens then if we pay for something in advance, like rent? Prepay the rent. So if we prepay the rent, for, what page is that on? The bottom of page 26, right? Rent for the months of December and January. We prepaid for 2 months' rent. Okay, so if we prepaid for it, we're going to assume that if we say, nah, we're not going to do it, they'll give us our money back, right? So if we prepay, I know in real life, but right now we're pretending like, well, I want you to understand the theory. Yeah, you could get your money back. You didn't use up the rent. Okay. Theoretic.
Okay.
Well, we're in a contract, so we can't get it back.
Well, we're going to assume we can. Okay? They didn't make us sign a lease agreement.
Right.
Yeah. So we could back out and they'd have to give us our money back. Okay. But we prepaid for 2 months. Now, have we used up that 2 months rent?
Probably not.
No, we hadn't moved in yet. Let's say. So what does that make that?
A prepaid account.
What is it?
Prepaid account.
A prepaid account, and what kind of account is that to the business?
Rent. It's an asset.
It's an asset. Good. It's an asset to us because we own too much rent and used it up. Just like the supplies are an asset to us because we bought the supplies and we hadn't used them up, right? Everybody get that little? Okay, so then just like in supplies, when we use up the supplies, the rent, as we use up the rent, is going to be treated the same way. We make an adjustment for that month and we'll take it out on the other side out of our revenue. Okay. Get the relationship? Okay. For prepaid expenses, anything you prepay. You might prepay insurance, you might prepay advertising. If it's a prepaid expense and used it up, it's an asset till you use it. Okay? All right. Let's keep going. Okay, and we're staying in balance, right? We paid it. We set it up as an asset. We took it out of cash, so we're still in balance. All right. Okay, we're going to stop. Well, let's see. And we've been talking about them. Come on back. Screen. Okay, there it is. What are assets? This is terminology.
Property owned by the business.
Okay, property, things of value, right? We call them assets. This is just an accounting term. All right. What's liabilities? What are liabilities?
Debits or obligations of a business.
The debts or obligations. The amount that the creditors own, right, of the property. The debts, you got to pay them. Okay. The obligations. What's owner's equity then?
Net worth.
Okay, net worth. Anybody know what net worth is?
It's the difference between the assets and the liabilities.
Oh, somebody hit it. Yeah, what y'all say? Y'all said it too.
Just everything within the business, property, supplies, equipment.
The equity is the amount of the assets that the owner has full claim to. So somebody said it over there. The difference between the assets and the liabilities gives you the equity, right? Right? Assets are on one side. If we take out the amount the creditors own, then it gives you the owner's equity. Right? Okay. The financial interest of the owner, how much he owns of the assets. All right. The liabilities, the creditors get first. They get paid first if something happens. They're number one. They get their money first before. It does, right?
Actually,
Yes, they do. Okay, what's a balance sheet? We're going to talk about the balance sheet a little bit, and then we're going to do one. Okay. A balance sheet
is a report on the financial position of the business. It reports the assets and liabilities and owner's equity of the business.
So the balance sheet is actually that equation that we have written. It's going to report, only it's a report, and it's going to show the assets. That assets equals liabilities plus owner's equity. It's a formal report. And on the balance sheet, you're going to show just what we've been talking about on this equation. You're going to show assets on one side with an equal sign, and on the other side, you're going to show the liability amount and the owner's equity amount. And they have to be in balance, thus it's called the balance sheet. Okay, so here's what we're going to do. And here's a balance sheet of Wells Consulting Company, right? We just took all that information we've been putting on that spreadsheet, and we're showing a list of the assets on the left, right? Left. You add up your assets, and you come up with total assets, right? Correct? Mm-hmm. And we pretend there's an equal sign here in the middle of this particular form, and then we're showing liabilities and owner's equity. We add those together. There's our equation. Right? Correct? There we go. There we go. Okay. So that you'll remember this forever, I want you to get out a sheet of paper, and I want you to draw a line down the middle. And let me do this on Elmo. I'll show you what I want you to do. If I can get Elmo. House, and you write down the amount you paid for it. What you paid for it. And we'll start with the biggies. If anybody has a house that they've bought, car, at the price you paid for it. What else you have? Come on, guys. You got books. You gotta have more than one car. You got books. You got electronics, right? Some of you may have furniture, jewelry, guns, musical instruments, anything that you own. For right now. So your liabilities are going to be the note on the car note, what's left on it, what's left on what you owe on your car note, what's left on what you owe on your house note, balance, credit cards, student loans, and anyway, I'm going to talk to you about student loans here in a minute too, but just to give you a heads up on what's going to happen with expenses are not liabilities. Liabilities are not expenses. Right, you're absolutely right, though. That would be an expense, and we're not covering that yet. Okay. I want you to know the difference, though, right?
Would the cost of the cell phone be a liability, though, if you hadn't paid it off yet?
If you bought it and you charged it on something, yes.
But then it would be, like if you charged on a credit card, then it'd still be just the credit card, not the phone itself.
Right, exactly. No. Assets are the property owned by the business, and liabilities are the amount that you charged or still owe on them. That's what that is. Okay? This is just a financial picture of the financial status on one day in time. On one day in time, this is your net worth. Okay, what I want you to do now to find your net worth or your equity or your capital is to subtract here's our equation. Assets equals liabilities plus owner's equity. Your total assets, your total liabilities, and you're going to figure out how much your net worth is.
In other words, add those two together, or subtract the one together.
Exactly.
Right?
Exactly. To get owner's equity, we would subtract the liabilities from the assets, correct?
We're a lot more than I thought we were.
Exactly, and that's what you were going to find out. I knew you were going to find that out.